Okay. Hi, everyone. I hope you're enjoying your summer. It's Darren and Kristian, and we wanted to take a minute to add a bit of context to the pooled fund update. So there's one attached to this email for year to date so far to the first 2 quarters of the year. But Kristian and I have been working on a big project to overhaul it. So we thought we'd give you a little overview of some of the changes that we've been making into the pooled fund that you'll see going forward that we hope really improve everything. So I think what we'll do, Kristian, by the way, hi, Kristian.
Hi, everyone. Hi, Darren.
I thought what we do is just go over a highlight of some of the changes. So first, again, a word from our lawyers. 2 out of 3 dentists agree your mileage may vary and objects are closer than they appear. Okay, moving on. So, Kristian, I gave you a big project a few months ago. Now that we've got you up to speed on all the data analytics software, risk management tools, and other things we have, and I said, I want to do a few changes to the pooled fund, and these are some of the bigger objectives that we had. So I'll just kind of cover, I think, the highlights of the changes and adjustments I was looking to make, and then we'll talk about how, with the work that you've done, we're implementing those changes. So the first thing is I wanted to be a little more defensive. I think with all the moves that we've seen in the last 18 months with central bankers on interest rate increases to hit the brakes on inflation, I'm worried they may overcook it a little bit. So we want to be a little more defensive because I think they're really trying to get a recession. So whether we get one or not, we'll see, but it seems like they're bound and determined to create one. We also, because of the interest rate changes, I'm like, how do we take advantage of that in the portfolios? We've had such an overweighting to US in portfolios for the last few years. I said, let's actually round out some of our diversification globally. After the pandemic, with an aging population and the work that we've done with Dr. Joe Coughlin at the Age Lab at MIT, I wanted to increase our exposure to the healthcare space. That made some sense to me. We obviously love dividend-paying companies, so how do we maintain a strong focus on that? We've also seen, and we talked about this in some of our previous videos, about this huge overweight that the indexes and the markets have had to a very small number of stocks. Indeed, this year, most of the market move has been done by 7 companies that seem to be nicknamed the Magnificent Seven, and there's a lot of stuff left behind. So in my 30-odd years of doing this, whenever we see everyone focused on one part of the casino, I like to look around to see what are they missing. So we've got an allocation to doing that. We've always had an overweight to financial services, and in the last year with interest rates having spiked so quickly, that historical overweight has hurt us a little bit. So how do we just round out the portfolio? We've done a really good job with our Dirty 30 model, which is one of the models embedded inside of the pooled fund. I know, Kristian, you've done a lot of work on that one, and that's a real favorite of yours, how well that thing's done. I think we should actually see if we can launch it as its own fund because it's had remarkable success just as a component. We also wanted to increase our use of passive strategies, which is designed to reduce some of our costs, and also it allows us to very efficiently expand our universe without adding a ton more securities into the portfolio. And that's actually one of the things I wanted to do, was reduce the number of moving parts. There's a lot of complexity, and so I thought if we can if we have 2 things and they're both doing the same thing, maybe we just go with one thing. We've done a lot of due diligence, and Kristian, you've been helpful at kind of expanding the number of frogs that we can kiss. Again, the frog picks its own pronouns, to really look to make sure we're aligned with the best managers and the best firms out there to support us in the program. So we're going to really leverage that work that we've done to have even greater access to those top tier specialists. And then just for the real investment geeks out there, we wanted to talk about increasing our credit quality in the portfolio and our fixed income positions, and also look at the duration. So duration is not the same as term. Duration is a bond sensitivity to interest rate changes. So we wanted to talk about that. And at the end of the day, we want value. So I also said, Kristian, where can we squeeze cost? Because again, this is all for the client. So we want to make sure we get the best value that we can. So I gave Kristian a dozen things to do. So you've been busy, right?
Fairly busy, but in a good way.
Pretty
I'm
busy.
happy to present the changes and what we've gone through.
Okay, I have 3 monitors going here, and I'm trying to figure out which one actually turns the slide. Hang on. There we go. So why don't, first of all, we just take a couple minutes and talk about, I think, the really big thing that's changed that is why we're having to make, I think, so many adjustments in the portfolios, and it's about interest rates. So would you mind just taking us through a couple of the pieces in this chart?
Yeah, for sure. So I know this has come up in our prior discussions, just given the significance of where interest rates are now versus where they have been in the past. So focusing first on the left side of this slide packet, we have interest rates since early 2000s. And the period that I'd like to pay particular attention to is immediately following the Great Financial Crisis, where we can see there was a prolonged period of near 0% interest rates within the U.S. Certainly, this affects asset allocation decisions. It fueled large spurs of equity rallies, given the bull market that existed immediately preceding the Great Financial Crisis all the way up until COVID. And so the environment that we've been operating in over the last decade plus is very much different than where we are now. And we can see interest rates now in the U.S. are a little over 5%. We haven't been at that level since immediately preceding the Great Financial Crisis. And if we go back over history, we have been at that level in the past, but the pace that we've gotten to this level is also very different. So just shifting focus quickly to the right side of the chart and looking at the yellow line there, the pace of interest rate increases over this past year is the quickest over the last 35 years, if we analyze several business market cycles over that time. So not only do we have interest rate levels now a lot higher than what we've seen, but the pace of increases is also at a historic rate. And that factors into many asset allocation decisions that we have to make. And certainly, as Darren mentioned, we need to find ways to construct our portfolios to also take advantage of these higher interest rates that we really have not seen for over 10 years plus. The next chart here just shows it from a global perspective. So, sometimes we can be quite US-centric, but if we just take a lens back and look at it from Europe and Canada, it's a very similar picture. In Europe, these two charts here go immediately post the Great Financial Crisis. So in Europe, we can see they had the Eurozone crisis, of course, in the mid-2010s, but they were operating at a near zero or below zero interest rate level for a very long time. And now we're seeing there that due to inflationary pressures, their interest rates are a lot higher than what we've seen in the very recent past. In Canada, very similar story to the U.S. We saw interest rates, of course, increase immediately prior to the Great Financial Crisis. And then we operated at a very low level for quite an extended period of time. And now we're at a level again where interest rates are around 5% in Canada. They recently raised rates, I believe it was last week. And so, again, we have to factor this into our decision-making of how we look to allocate funds across the pooled fund and how we're making decisions. And that just brings us to the final slide here. And that's how do we achieve those objectives?
Sorry, Kristian. Sorry, just to interrupt. Sorry.
Yeah.
Just before I go on, I think one thing also to note about all the three slides for the U.S., Europe, and Canada, all of them have this assumption that interest rates are going to reach a peak at some point in the next 18 months to 24 months and then begin declining. And that's predicated on this idea that they crack the back of inflation and central bankers will be just as responsive as they were raising rates as dropping them. So we're hopeful that that's the case. That does seem to be the predominant forecast. We're going to base a lot of our changes on maybe that happens, maybe it doesn't. I'm not assuming that's going to happen 100%, excuse me, but it is something to be mindful of, is that we don't believe that these rates are going to stay at these levels for a long time, right? So let's jump to...
Great point to make. And I think, even if rates do not come down as quickly as we may see in some of these forecasts here, and when these two models do forecast, rates will peak and then come down over time as the central bank responds to an easing of inflationary pressures, possibly some labor market slack if unemployment increases. At the end of the day, there are opportunities regardless of if there's higher for longer or if rate cuts happen. We're looking to position ourselves to take advantage of where rates are now.
Right. So let's cover quickly some of the changes that we made. And again, there's lots of individual changes, but I think we're just going to hit the highlights to keep the video today fairly short. So would you mind just summarizing based on all the work you did, and we had Pedro do a ton of adjustments for us, but what that result is?
So the result of this, a couple key things I want to focus on. One, we turned over more than 35% of the pooled fund. So obviously not an insignificant amount of the pooled fund We've had sales, we've sold and reduced over 20% of the securities in the pooled fund. But on top of that, existing securities we reallocated in between for names that we've seen that we like. We're confident that they'll continue to produce. And so we've reallocated more money there, for instance. On top of that, Darren, you spoke about adjusting our approach slightly. So certainly over the past few years, we've had quite an overweight to financial services. We still continue to like names within the financial services space, but we've taken steps to reduce that overexposure slightly from what was 31.6% to now 19.2%. In line with that reduction in financial services exposure, we've taken that opportunity to increase other areas of the portfolio that we continue to see opportunity in. Partly that includes increases in our technologies and industrial exposure by approximately 3 and 2% respectively. And we've also taken an opportunity to increase our defensive sector positioning, and largely that's been accomplished through a near 7% additional allocation to healthcare. And that goes obviously along with what you've mentioned, Darren, a lot of the secular themes that we like with healthcare and what you've had an opportunity to discuss with Dr. Joe at the MIT lab. We've also looked to increase our global equity exposure, so ex-Canada equity exposure. Yep. Sorry, go ahead.
I think we should also mention that one of the other things we did to help with the defensiveness of that portion is we've increased our component to healthcare, but we've also done it using a covered call strategy, which takes the volatility of that sector and actually adds to our income stream. So we've actually done a couple of things there to increase the defensiveness. So in healthcare, and then adding a covered call component, which turns volatility into more income. So we're actually getting almost a double-digit income stream off of that allocation. So a couple of things we did. Sorry, I'm probably getting too boring here. Keep going. So we also increased our global equity weighting.
Yeah, we've increased our global equity weighting by approximately 10%. And we've gone over metrics that show over the past 10 plus years, U.S. equities have certainly offered a lot of outperformance, but there are trend patterns over time that may suggest that global equities may be poised for some outperformance over the coming years. And so we want to be able to just position our portfolios that we're diversifying not only by sector, but by geography. The other thing that we've done, and this goes back to the fixed income discussion, is one, we've increased our aggregate fixed income duration from 0.45 years to 5.77 years. Now, without getting too technical, what this means is we've just increased the interest rate sensitivity of our fixed income. So we want to be positioned to lock in some of those higher yields. And if there is a rate cut in the future, we also want to be positioned to get the capital appreciation from the rate. On top of the duration expansion to approximately 6 years, we also wanted to increase the credit exposure of our portfolio. So we've gone from 68% investment grade credit exposure to now 82%. And that falls in line with the defensibility of our portfolio. So not only are we looking at equity sector allocation, but from a fixed income standpoint, where can we look to maybe be a little more defensive? And that's by going a little bit up the credit quality curve. Now just moving on to a couple additional changes here, and we're going to get into some risk metrics. But firstly, Darren, I know you stated one of the big points was reducing the overall cost of the pooled fund. And so based on analysis, we've been able to reduce overall cost by approximately 10 basis points, which is actually quite a sizable margin. It would represent almost a 15% cost reduction on a relative basis to where we are now. Another key factor is maintaining our levels of distribution within the pooled fund. And part of that is maintaining a yield still above 4% within the pooled fund. And part of that is because we've been able to continue to allocate towards high quality fixed income that's yielding in a range from 5 to 7%. Those cover call strategies that you mentioned, Darren, is another way to really extract a lot of income from our equity positioning and continue to allow us to have these distribution levels. And now just on a risk-adjusted basis, it can be summed up as we've made the portfolio more efficient when we're doing stress and back testing. And the way we've looked to measure that efficiency is through one, upside and downside capture. So just getting a little granular here for just a second. Upside capture just means how much of the market up returns you're capturing within your portfolio. So we've been able to increase that. So theoretically, we'll be better situated towards a positive market, and we're still maintaining a 60%, less than 60% down capture, which means when the market goes down, the pooled fund should not go down as much as the market. It'll go down about 60% or less of the market declines based on our historical testing. And then lastly, Sharpe ratio, it's just simply a measure of risk-adjusted returns. We want to make sure that we're delivering as smooth of a return experience as possible. And so by maintaining or improving our Sharpe ratio, it just means that we will hope to provide better risk-adjusted returns over the long haul. So hopefully that's summed up some of the changes. Certainly, when we see the next quarterly report, the latest report for the end of Q2 won't reflect a lot of the changes, but you'll see many, many line items. But hopefully this has just captured the essence of what we were trying to accomplish. And certainly, based on the testing that we've done, we're quite confident that the changes will hopefully provide a good result.
Right, and so thank you for covering that. And I think for everyone watching, I think it's important to note that what's that line about when the facts change, we change. So we've done a lot of work, and we weren't happy with some of the performance that we saw. We're actually pacing okay relative to our low risk benchmark, but again, the world's changed. We got to change with it, and with your help and support, Kristian, we're able to really do a deep dive to make sure that the adjustments we made were in line to what we wanted to accomplish. So that's the new recipe, as it were. Same mission, same mandate, just we had to make some adjustments. Hopefully we'll see that improvement. And again, the back testing of the software says we should, but the future will tell. So with that, any questions, please reach out to Kristian or I, and we're happy to share more. Thank you very much for watching to the end, and enjoy the rest of your summer. Kristian, thank you for your hard work. I appreciate it.
Yep. Thanks, everyone. Have a great summer.